Well, the world's 10 wealthiest men doubled their fortunes during the first 2 years of the pandemic as poverty and inequality soared.
When a billionaire needs $50 million in cash, they do not sell anything. They pick up the phone, call their private bank, and borrow against assets they will never liquidate. At an interest rate so low, it barely registers against the compounding growth of the portfolio backing the loan. The assets keep appreciating, the tax event never arrives, and the 50 million moves into the next private deal before the rest of the market even knows the opportunity existed. This is not a loophole. This is the system. And it has 7 layers. By the time this is over, you will understand every one of them, and you will understand why the gap between the merely wealthy and the dynastically wealthy is not a gap in intelligence or ambition. It is a gap in architecture. Most people believe that wealth compounds through investment returns.
The richest family in American history hasn't disappeared. They've simply mastered the art of wealth without ostentation.
Buy the right assets, hold them long enough, let time do the work. And that is true, as far as it goes. But it only describes the visible surface of how serious capital actually behaves. Because at the level of true generational wealth, the kind that survives market crashes, tax regimes, political upheaval, and the passage of multiple human lifetimes, the returns are almost secondary. What actually preserves and multiplies wealth across generations is not a portfolio. It is a private infrastructure, a set of structures, relationships, and access channels that the ultra-wealthy have built specifically to ensure that capital stays in motion, stays protected, and stays inside the circle. The people inside that circle are not fundamentally different from the people outside it, but they have access to something the outside world was never designed to know about. And once you see that infrastructure clearly, the way wealth works in this world becomes an entirely different story. It begins with an institution that 44,000 people search for every month.
Governments to tax the gains made by billionaires whose wealth increased by an average rate of $1.3 billion a day.
And that most of them, when they find the definition, still do not fully understand. The family office. Not a brokerage account, not a wealth management firm, not a private bank, though it often has relationships with all three. A family office is a private organisation, sometimes employing dozens of people, built to serve a single purpose: the preservation, management, and multiplication of one family's wealth across generations. It is, in the most accurate description possible, a private government for money. The Rockefeller family established what many consider the first true American family office in 1882. At the time, John D. Rockefeller's Standard Oil fortune was generating wealth faster than any conventional financial structure could manage or protect. The family office he built was not designed to invest, it was designed to govern, to create a permanent institutional structure that would outlast any individual family member, that would maintain the philosophy and discipline of the founding wealth through grandchildren and great-grandchildren who had never earned a dollar of it themselves. Today, the Rockefeller Family Office, now operating as Rockefeller Capital Management, manages assets across multiple generations of a family whose founding fortune was accumulated a century and a half ago.
David Rockefeller Jr., now in his 80s, commands respect as chairman of Rockefeller Capital Management.
That is not investment performance. That is institutional architecture. Jeff Bezos runs his personal capital through Bezos Expeditions. The Walton family, heirs to the Walmart fortune, operates through Walton Enterprises, a structure so sophisticated it employs its own team of tax attorneys, investment professionals, and legacy specialists working exclusively on family capital. These are not brands. They're not public entities. They are private operating organizations whose sole client is a single family. And the services they provide go far beyond anything available in the conventional financial system. Legal structuring, tax optimization, private deal sourcing, estate planning across multiple jurisdictions, family governance, which means managing the human dynamics of inherited wealth, the disputes, the diverging risk tolerances, the members of the next generation who want to sell and the members who want to hold. A family office is not just a financial institution, it is a civilization in miniature, built around the continuity of capital. But the family office is only the foundation, because what it provides access to, the thing that makes it genuinely transformative rather than simply efficient, is a network. And the network is where the real story begins.
Their wealth flows through the global economy like an underground river, rarely seen on the surface, yet profoundly influencing the landscape it passes beneath.
Private deal flow is the term for investment opportunities that never reach the public market. They're not listed on any exchange. They're not advertised. They're not available through any conventional brokerage or investment platform. They exist in a layer of the capital markets that operates entirely through relationships. Between family offices, between private equity funds, between the interlocking boards of major corporations, and between the private banks that serve the ultra-high net worth community. And the returns in this layer are categorically different from what the public market produces. Here is how it actually works. A family office in Geneva has a relationship with a private equity fund that is raising capital for a mid-market acquisition. The fund is not taking external investors. The raise is happening entirely through existing relationships. The same 20 or 30 family offices and sovereign wealth funds that have invested in every previous deal. The opportunity never surfaces publicly. It does not need to. The capital is already waiting, already trusted, already allocated before anyone outside the circle hears a word. The transaction closes. The returns, over a 5-year hold, come in at multiples that would not be achievable in any publicly traded equivalent, and the relationship deepens. The next deal flows through the same channel, to the same partners, with even less friction than the one before. This is the mechanism behind something that sounds abstract until you trace its actual structure. Billionaire capital circulates between the same hands over and over across decades, not because of collusion, not because of conspiracy, but because trust is the most efficient financial infrastructure ever built. And trust, at this level, is cultivated deliberately, maintained carefully, and extended only to those who have already proven themselves inside the circle. A board seat at one company creates an introduction to a co-investor. That co-investor brings a family office into a real estate development in a jurisdiction where nobody outside the deal knows the opportunity exists. The real estate deal generates a relationship with a private bank. The private bank introduces a lending structure that allows the family to access liquidity without selling a single asset. And the cycle continues, compounding not just capital, but access. This is what the word network, in the ultra-wealthy context, actually means. It is not a social circle. It is a capital circulation system, and entry into it is not purchased. It is earned, slowly, through demonstrated alignment, shared risk, and the kind of patient relationship building that most people never have the time, the capital, or the structure to pursue. But there is a mechanism inside this system that is more counterintuitive than almost anything else in the billionaire financial toolkit, and it is the one that most clearly separates the way the ultra-wealthy think about money from the way everyone else does. It involves debt. Specifically, the strategic use of debt not as a burden, but as a precision instrument for preserving and multiplying capital. The strategy is known in financial circles as buy, borrow, die. The name makes it sound simple. The mechanics make it one of the most powerful wealth preservation tools in existence. Here is the structure. An ultra-high net worth individual accumulates assets, stocks, private equity positions, real estate, art, collectibles, and allows them to appreciate over time. Rather than selling those assets when liquidity is needed, which would trigger a capital gains tax event that could reach 37% or higher in many jurisdictions, they borrow against the assets through a securities-backed line of credit. The interest on the loan is significantly lower than the return on the assets backing it. The assets continue to compound. The loan is serviced from cash flow or from other positions, and when the individual eventually dies, the assets transfer to heirs at a stepped-up cost basis, which means the capital gains that accumulated over a lifetime are, in many legal structures, never taxed at all. Read that again. The appreciation that built over decades, that compounded through market cycles, through private deals, through real estate positions held for generations, passes to the next generation without triggering the tax liability that would apply to any conventional sale. The wealth does not shrink at the transition. It transfers whole, and then it begins compounding again. While most working people pay income tax at the highest marginal rates on every dollar they earn, the ultra-wealthy have engineered a world in which income, in the conventional taxable sense, is largely optional. They live on borrowed money. They pay interest that is deductible. They let their assets grow, and they pass the growth to their children without ever realizing it as taxable income. This is not illegal. It is architecture, and it is available only to those with the assets, the advisors, and the institutional infrastructure to execute it precisely. If the mechanics of how this world actually functions are the conversation you want to stay inside, the real systems, not the surface story, the rarest air exists for exactly this. Subscribe and remain in the room. The debt strategy is powerful on its own, but it operates inside a larger tax architecture that makes the whole system nearly untouchable for those who understand it. And the structures involved have names that most people have never encountered. Not because they are secret exactly, but because they are simply never discussed in the financial media that the general public consumes. The dynasty trust is one of the most significant of these. In many jurisdictions, a dynasty trust can be established to hold assets for a period that extends, in some states and countries, for up to 360 years, or, in certain offshore structures, in perpetuity. The assets placed inside the trust are managed for the benefit of the family across generations. They are protected from creditors. They are insulated from divorce settlements. They are structured to minimize estate taxes at each generational transition. And they are governed by a trustee, often a corporate trustee with no personal stake in the outcome, who is legally obligated to follow the wishes of the trust's founding document, not the preferences of any individual heir. The implication of this is profound. A dynasty trust is not a financial product. It is a time machine for capital. The family that establishes it is not just managing wealth for themselves, they are setting the terms under which their great-great-grandchildren will interact with the family's capital, decades or centuries from now. The founding generation does not simply leave money, they leave governance, they leave values, they leave rules. And the trust ensures that no single heir, no single poor decision, no single market catastrophe can unravel what was built. The donor-advised fund is a different instrument, designed around a different problem. The ultra-wealthy use DAFs not primarily as charitable vehicles, though they function as such, but as tax optimization tools that allow them to take an immediate deduction on a contribution while retaining influence over how the capital is eventually deployed. A billionaire contributes $200 million in appreciated stock to a donor-advised fund. They receive a tax deduction for the full value of the contribution in the year it is made. The stock is sold inside the fund without triggering capital gains. The capital then deploys, over years or decades, to charitable causes that the family selects. The family's influence over those causes often extends, through foundation relationships and naming rights, far beyond what the tax deduction captures. It is simultaneously a tax strategy, a legacy strategy, and a social influence strategy. And it is structured entirely within existing law. The Opportunity Zone, introduced in United States tax policy in 2017, created a mechanism by which capital gains taxes can be deferred and in some cases reduced or eliminated by investing in designated economically distressed areas. In practice, family offices and private equity funds with sophisticated tax teams have deployed this mechanism across real estate development projects in ways that generate both genuine economic activity and significant tax efficiency. The public benefit and the private benefit exist simultaneously, and the family office is positioned to pursue both with equal precision. But none of these structures, taken individually, captures what makes the billionaire financial system genuinely impenetrable to those outside it. What makes it impenetrable is the combination, the way each instrument works with the others to create a system that is, in aggregate, far more powerful than any individual component. The family office manages the dynasty trust. The dynasty trust holds the private equity positions. The private equity positions generate returns that are borrowed against through S-blocks rather than liquidated. The borrowing generates liquidity that funds philanthropic contributions through DAFs, creating tax deductions that offset the modest income that cannot be fully sheltered elsewhere. The Opportunity Zone investments generate both deferral and community relationships that produce new deal flow. And the entire structure is managed by a team of specialists, tax attorneys, estate planners, investment professionals, family governance experts, whose collective knowledge represents an institutional advantage that no individual advisor available to the general public can match. This is the architecture. And the architecture explains something that most people experience as a frustrating mystery. Why wealth, once it reaches a certain scale, seems to compound almost independently of effort, almost independently of market conditions, and almost independently of the decisions made by any individual family member. It is because at that scale, the wealth is no longer dependent on individual decisions. It has been institutionalized. It has been embedded in structures designed specifically to persist. And those structures require only one thing to function: continued access to the network that feeds them. New money disappears in 3 generations. This is an empirical observation documented across cultures and centuries. The first generation builds the wealth through exceptional intelligence, timing, risk tolerance, and effort. The second generation inherits the wealth and the habits of scarcity that produced it. The third generation inherits the wealth without the habits, and frequently without the structures that would protect it from their own decisions. Shirt sleeves to shirt sleeves in 3 generations. It is a proverb in English, in Italian, in Chinese, in Japanese. Every major wealth culture has its own version of the same observation. Old money does not follow this pattern. And the reason is not virtue, it is not superior intelligence, it is not even particularly superior values, though the culture of old money often emphasizes stewardship in ways that new money does not. The reason old money persists is that it was placed inside structures designed to outlast the people who built it, and designed specifically to protect the capital from the humans who will inherit it. The dynasty trust does not ask the third generation whether they want to sell. The family office does not take instructions from an heir who has never managed a dollar. The governance structures of serious old money ensure that the capital is managed according to principles established when the wealth was created, not according to the preferences of whoever happens to be living off it in any given decade. This is the most counterintuitive thing about the billionaire lifestyle from the inside. The ultra-wealthy, at the level where wealth truly persists across generations, are not particularly free with their own capital. They are stewards of a structure. They are custodians of a system that was built before them and that is designed to outlast them. The freedom they experience is not the freedom to do whatever they want with the money. It is the freedom that comes from never having to worry about the money, because the money is managed by a system that does not depend on their vigilance. The gap between a person worth $5 million and a person worth $500 million is not primarily a gap in investment returns. It is a gap in access to this infrastructure. The $5 million person uses a financial advisor. The $500 million person uses a family office, a private bank, a network of co-investors, a team of tax attorneys, and a set of trust structures that took years and significant legal expense to establish. The returns those two people earn from their capital will diverge not because one is smarter than the other, but because one is operating inside a system specifically designed to compound advantage, and the other is operating in a market that is available to everyone, which means it is advantaged by no one. The real network is not the capital, it is the information. The ultra-wealthy know what is happening 3 moves ahead, not because they are more intelligent than the people outside the room, but because they are inside rooms where those decisions are being made. A family office principal who sits on 3 boards does not sit on those boards for the director's fee. He sits there because the boardroom is where the real conversation happens. The conversation about where capital is going, which regulatory environments are about to shift, which private companies are approaching a liquidity event, and which relationships are worth cultivating for the decade ahead. That information does not flow downward into the public market. It circulates inside the network, and by the time it becomes visible to the general public, by the time it shows up as a market move or a news story or a publicly announced transaction, the people who acted on it have already moved to the next position. This is the deepest truth about how the ultra-wealthy stay wealthy. It is not a secret in the conspiratorial sense. The structures are legal. The relationships are legitimate. The information, in most cases, is available to anyone willing to spend decades building the access required to receive it. But it is a system. A closed, self-reinforcing, deliberately maintained system. And the people inside it have every incentive to keep it functioning, and very little incentive to explain it to anyone who is not already part of it. The question worth sitting with is not whether this system is fair. Fairness is a separate conversation, and a long one. The question worth sitting with is what it actually reveals about the nature of wealth, about what money is at its highest expression, and what separates the kind of capital that lasts from the kind that evaporates. What it reveals is this: money, by itself, is fragile. It can be lost, taxed, spent, divided, litigated, and inflated away. What makes capital permanent is not the money. It is the structure around it, the institution, the network, the relationships, the governance. The multi-generational discipline that treats wealth not as a reward to be enjoyed, but as a responsibility to be managed. The billionaire lifestyle from the outside looks like freedom: private jets, families, offices in Geneva, deals in rooms nobody else enters. And there is freedom in it, a specific, extraordinary kind of freedom that most people never experience. But from the inside, what sustains it is something much closer to the opposite of freedom. It is constraint, it is governance, it is a set of structures deliberately designed to prevent any individual from doing whatever they want. Because whatever any individual wants in any given moment is almost always less wise than what a carefully constructed institutional framework was built to do. The families that last are the ones that understood this early. The families that disappear understood it too late, or not at all. For more on the hidden architecture of wealth, the systems behind enduring power, and the mechanics that separate capital that compounds from capital that fades, the rarest air is where that conversation belongs. Subscribe and stay inside the room that most people never find.